welcome to Investors Guide and thanks for tuning in. We have a packed show lined up for you today. As always, as we help you sort out your finances. And I'm glad you joined us this week because it's been a rough week for those of us who invest in equity. The market has been very choppy. So we're going to spend the next half hour really figuring out what you should be doing with your investments right now, especially when we see this kind of volatility in our stock market. Now remember, email ID is at the bottom of your screen where you can send us your questions. Let's get straight to it. In the next half hour, we'll first start off by helping one of our viewers plan for his child's future using mutual funds. Then we'll also tell you what you should do with your funds if you've invested in equity and you now have negative returns. And in our continuing segment on reviewing tax saver funds, today we look at the HDFC tax saver. All of that coming up later on the show. All right, let me first introduce Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert. He needs no introduction on the show. He joins us every week to answer our questions. Dhirendra, thank you so much for joining us on the show. Let's move on now to our portfolio versus portfolio segment. Well, Vaibhav Bakshi has written in, Dhiren, he's 39 years old and he wants to plan for his daughter, who he tells us now is 4 years old. And he tells us he's a long-term investor and he plans to increase his contribution to his mutual funds as the years go by. Now, his goal is to have 2 crore rupees for his daughter's education, which should be in about 15 or 16 years considering she's 4 years old. Now, these are his investments. He has 80,000 rupees going into the PPF every year. He's investing in a couple of tax saver funds, the HDFC tax saver, SBI Magnum tax saver, Reliance and the ICICI Prudential tax savers as well. Apart from which, he has a fund from Franklin and he also has one HDFC Top 200 and the HDFC Long Term Advantage funds. Now, he seems to be putting about 2 lakh rupees in these funds at the end of the year. Do you think that's enough? First of all, is this a planned structured portfolio? Would you recommend he uses one of our portfolios instead?
No, I think, he will require a more, organized portfolio. Of course, he has to carry on either with a PPF or seriously consider opening a NPS account because that will be the only market-related investment and that will be long-term investment for his own retirement, not for his accumulation for his daughter. But that about I would say that he should just simply match a map to our growth portfolio or our aggressive growth portfolio and be methodical about it, periodically review it. And this looks like, these funds are not questionable. They are not bad funds. But I don't see a game plan. And also, the tax saving plans, the investment in tax saving funds, 1,000 rupee investment. And on the other hand, you have your fixed income tax saving investment, which is to the tune of 80,000 rupees per annum, which I think is quite, it reflects the, being a less thoughtful or not a less thought that has gone into constructing a portfolio. I would say aggressive growth portfolio, and for his tax saving investment he should just get anchored to new pension system.
So use the new pension scheme from now on for your tax saving investments, and of course use our aggressive growth portfolio that's flashing on your screen for the rest of your investments. The difference basically between the plan that you have right now and the one that's flashing on your screen is that it's more structured. These funds complement each other better than the ones that you have picked right now. And of course, remember, if you are planning for your child, remember to make sure you have health insurance for your entire family in place and you have life insurance for yourself of about 10 times your annual income, just to make sure that your child and your family are secure. Remember, you can write back to us if you need anything else, wherever. It will be our pleasure to answer your questions on the show. Let's move on now to our hold or sell segment. Today, our next question comes in from Anant Kumar. He's 35 years old and he's been investing in SIPs for the last 1 year, he tells us. He sent us a list of the funds that he has invested in. He tells us their returns are now negative, and he also has put 2 months of his salary in a fixed deposit as a backup, as a contingency fund. He wants to have a retirement corpus in about 15 years and he wants to save for his son's education. His son, he tells us, is 2 years old. He has listed out his term insurance plans and his health insurance, and he seems to have that under control, and he's also invested in a couple of ULIPs as well. Now, he sent us a list of the funds that he's invested in, and he's really unhappy about the fact that his funds are currently giving him negative returns, which is not surprising given where the market is right now. So I want to go over his list of funds first, and then I want to talk about what happens, what an investor should do when they're looking at their funds and their mutual funds at this point and they realize that it's trading in the negative. What should they do? So first on his list is the DSP BlackRock Top 100 fund. Should he continue investing in this one?
Uh, yes, it's an excellent large cap fund, but on a standalone basis, it's a hold.
There might be some overlap with the next fund on his list, the DSP BlackRock Equity Fund. Is there an overlap there? Would you prefer he chooses one of the two?
Not only an overlap, I would say that if he's getting the management from DSP and he's investing for 15 years, he's investing regularly, and he's willing to assume some risk, and it's not a risk given his time frame. So I would say that the earlier one, the DSP Top 100, should be discontinued in favor of DSP BlackRock Equity.
Right. The next two funds of his list will also have a similar overlap, the HDFC Top 200 and the HDFC Equity Fund. Would you prefer he picks one of the two and consolidates that money as well?
Yeah, absolutely, and I think it will prove to be far more rewarding. What you are referring about his negative return in the past 1 year he has got started. He will look back 5 years from now and will be very pleased with it that his portfolio was not generating return in the early years. You are buying it cheap, stay on course, and looks like you have chosen good funds.
All right, the next one on his list is the Franklin India Blue Chip Fund. Will you continue investing in this one as well?
This is again a large cap fund. It's a good large cap fund, but and has a long history. He should continue investing here as well.
All right, the Birla Sun Life Dividend Yield Plus is the next one on his list. It's also followed by another Birla Sun Life fund. So, do you think there's an overlap here between Frontline Equity and Dividend Yield, or do you think he can safely continue investing in both these funds?
The strategies are different, and there may not be a significant portfolio overlap between Birla Sun Life Frontline Equity and Birla Sun Life Dividend Yield Plus fund. But still, I would say that because he has DSP BlackRock Equity or HDFC Equity, then he can do without, then that combined with Franklin Blue Chip, then he can do without having the Birla Sun Life Frontline Equity. I think a Dividend Yield Plus will be a reasonable fit in a portfolio following a different strategy.
Okay, the last one on his list is the IDFC Premier Equity Fund. Should he continue investing in this one as well?
Yeah, absolutely. It is an outstanding fund. It's part of of our portfolio as well, and so this way his portfolio gets trimmed. He should hold IDFC Premier Equity.
So hold IDFC Premier Equity. So remember, they're telling you to consolidate the funds that you've invested in. But the bigger question, and the one that I want to answer from all of the viewers who've written in this week, is that they're seeing their mutual funds currently trade negative. They're a little upset about the fact that the money they've accumulated over the last 3 or 4 years also seems to be dwindling in front of their eyes. There is a cause, therefore, maybe a certain amount of panic. What would you recommend that investors do right now when they're looking at their investment? Should we just hold tight and continue putting our money into mutual funds, or is there need to panic?
Not only you should stay put, but should continue investing regularly. You are buying cheap, and if you have time on your side, I think it's good news that you are buying it cheap. And I would differ from your assumption that anybody who has invested regularly over the past 3-4 years will be in red, will have negative return, would have lost money if he has to realize all that money, because anybody who has been investing regularly over the past 3-4 years, I think will be sitting on substantial profit. I think the problem is anybody who got started later, in past 12 to 18 months, I think he will have nominal negative return. And I think the kind of volatility which we see right now, this will come to your advantage. And if you are investing for many years, it's good news that you are able to buy cheap.
All right, Anand, that's the advice going out to you. You need to consolidate your mutual fund portfolio. There seems to be an overlap between the funds that you've chosen, and continue investing right now, even if you see negative returns. These are returns that you will actually see come in the next 4 or 5 years, and it will make a huge difference that you continue to invest at this point. Write back to us if you need anything else. But then we have one last question in this segment. Dr. Yasir has written in from Bangalore. He tells us he's been investing in the SBI Contra Growth and the Reliance Growth Fund through an SIP, but the funds are not doing very well. Now, he tells us he and his wife want to invest 10,000 rupees more in their funds, and he wants to know if he should invest in these funds. Are they good, or should he be moving his money into another fund altogether? What should he do?
They are right in their assumption, because these two funds are not as they used to be. And both funds are not extremely disappointing, but they are not as inspiring or as the kind of return they gave a few years back. And I don't think they seem to be getting their steam back. So I would say should consider moving your money from these two funds to superior performing fund which shows greater promise. And I would say yes, it's time to halt your investment in these two funds.
All right, so halt your investments in these two funds. Dr. Yasir, that is the advice going out to you. Remember, write back to us if you need anything else with your investments. We're going to slip into a quick break. On the other side, we're going to talk about the HDFC Tax Saver Fund. Remember, it's time for you to start putting money in your tax savers. Don't wait till the end of the year. So we'll tell you if this is the tax saver that you should pick. That's after the break. Don't go anywhere.